How we doing, sir?
Hey, Spencer, how are you? I'm doing great.
Good. How the week? It's been such a boring. I've been telling everyone it's been such a boring week, right?
You know, we have 1 or 2 good days in there, but that was it. You know, and usually following a holiday, you get a 3-day holiday, right?
Yeah.
With Friday, we normally get some continuation bullish movement from that. So we're getting nice little moves. I think we're spoiled with these 200 and 300 point, 500 point, 800 point moves on the Dow, and now we see 100 points and we feel like nothing's happening.
Maybe that's right. All right, I want to give you the floor. I'm going to hop off. I'll be in the background, but take it away, sir.
Fantastic. I hope you're all doing phenomenal. I hope you guys are all set to rock and roll today. I want to talk about a strategy that we haven't discussed here before. It was one we talked about last week that I said we would bring up and cover this week because questions came in right at the very end as we were talking about what is called a diagonal spread, which is a way to do what's called a poor man's covered call. It's a way of renting out a stock without ever owning the stock. And credit spreads came up, and I said we don't really have the time to cover that here today, so let's go ahead and bring those up in the next session this week and cover that there. So let's go ahead. If you would, give me a 1 for yes if you have traded credit spreads before. Give me a 2 for no if you have not traded credit spreads before. And I will let you in on a little tip. For those of you that do not know me, the more you participate, the more extra, the more bonus, the more candidates you'll wind up with from me. So I would suggest hitting that 1 or 2. And whatever it is, if you haven't traded them before, go ahead and hit the 2 and let me know. If you have, hit the 1. That's okay. All right. Hey, Manny, how are you? So we kind of have a mixed bag. It looks like we've got a lot of 2s just popped in there now. And then TS decided 31 was some form of 1 or 2. Maybe it's 3 plus 1 divided by 2. Or 3 divided by 1 gives us, I don't know. Sorry, don't know how to figure that one out. 55. Okay, there you go, Naval. Perfect. All right. So let's discuss first what a credit spread is. Let me go ahead and grab my Paint program. Let's make that full screen. And let's talk about this. All right, so let's go ahead and insert text in here. And we're going to talk about credit spreads. All right, and I would suggest you screenshot this throughout the time we're doing this today so you capture this at least as a basis, as a starting point of what you should be looking at for a credit spread. So the very first thing is a credit spread is a 2-legged spread. What does that mean? And both those legs, by the way, are options.
Hey, Robert, can you make the font just a little bit bigger?
Sure.
All right.
We can do that. Let's try a little more. How's that? Better, Spencer?
Great.
Yep. Okay. So it's a 2-legged spread, and we're dealing with options, right? That is our, that's our trading vehicle, our options. Now, they could be bullish or bearish. The 2 types of spreads, by the way, are called bull put spread, also known as BPS, bull put spread, and a bear call spread, BCS, bull put and bear call. So let's talk about just the first one, and that's all we're going to deal with today is the first one. We're not going to deal with the second one, just the opposite rules, right? Bull put spread, 3 words. Write this down if you don't know these. The word bull put spread, all 3 words have a particular meaning to it. Bull, meaning a bullish pattern. You think the stock is bullish. We're using put options to spread out our risk. So a bull put spread is a bullish trade using put options, spreading out our risk. And the basis or the starting point of this strategy would be this. If you had a stock, and let's say the stock is, the ticker symbol is PFA. Now, don't trade this one. I made it up. It's plucked from air, okay? let's say pluck from air right now, just to make it very simple numbers, is trading at $100 a share. All right, what we would do is, if we were going to take this trade on, it's two components, two individual or combined, but they could be two individual trades that you would do. One of the trades would basically be a naked put. Oh, that's a dangerous strategy, Rob. Well, that is why we're doing it as a spread, to remove that danger. But if you were not utilizing a spread, you would sell a naked put, which means to sell a naked put, as an example, we would let me write it down and I'll abbreviate. Sell to open, STO, sell to open. We would sell to open, let's say, the $95 P for put. So what are we doing? Stock is trading at 100. We're selling that $95 put, which is somewhere down below here. And let's say that someone will pay us $1. Don't worry about the exact numbers. I'm making them up. Remember, pluck from air, which is always my go-to symbol. So they pay us $1. The stock's trading at 100, and we just took on an obligation that said, you can force me. You can make me. You, who's you? Somebody. Don't worry about who it is. Don't get hung up in the weeds. Somebody can make you buy the stock at $95 a share, but it's trading at 100. Who in their right mind is going to make me buy it at 95 when it's trading at 100? Well, nobody is. But why would someone do this? Well, we said for us, this is a bullish trade that we're looking at. And if we're bullish, we think the stock is going up. Well, if someone is buying a put, when you buy a put, you are bearish, you think the stock is going down, right? If you're taking a directional trade. So they think the stock's going down, you think it's going up. Not everybody's going to be right in this transaction, right? You're going to have a winner in this, not multiple winners on this trade. But if I am right and the stock does go up, let's say the stock goes up to 101, 104, 187, it doesn't matter. It goes up anywhere higher than $100. Let's say it goes to 110. So on expiration Friday, which is today, right? Expiration Friday, the stock closes at $110 a share. If it's trading at 110 and you have the right to make somebody buy it from you at 95, would you do that? Of course not. Who in their right mind is going to make someone buy it at 95 while it's trading at 110? So what happens? I keep the entire dollar. Well, what if the stock went sideways? What if it stayed right at 100? Well, same scenario. It's trading at 100. Would you make somebody buy your shares at 95? No. But Rob, why would anybody do this? What if the stock goes down? See, if the stock goes down maybe a little bit, if the stock goes down and stays above 95, am I okay? Yeah. Because if the stock is at 96 and someone can make me buy it at 95, they won't. They will not. No one's going to lose money on this transaction just to say, I'm going to make you do this. It's not going to happen. So we're looking at this transaction here saying, as long as the stock stays above 95, we're okay. Right? That's a naked put. But where do you get in trouble then? Well, what if the stock opens up tomorrow? It's $100 today, and tomorrow it opens up at, half. Let's say it opens at $50 a share. Is somebody going to make you buy it at 95? That is the risk in a naked put. Now, I want to take that risk away by turning it into a credit spread. All right, so let me check out some of the comments here. Buy to close. Let's see. Rob, would I be, this is Brad, would I be right to say that you would just use these for swing trades, not really practical for day trades? Actually, Brad, no. We have one trade that we do. Well, we actually send 3 trades out every single day to our subscribers. And inside of those trades, we tell you what the setups are. And if we're bullish, and they're all day trades. Everything I send out on this one service is a day trade. And I'm going to share 2 of them with you today, Brad, that we did today. You're going to see all the numbers. We ran them in toss. You'll see everything we did. Now, we only do 1 contract. That's the rule, is we do 1. And the reason for it is I want to make it affordable to everyone in here. So as an example, let me see my numbers here just to get a better. I've got about 9 or 10 trades under my belt today, so I can't remember all of them. So let's see, that's $2.50. That right there is all right. So you would have needed to do either one of these, Brad. You would have needed $250 to do this trade intraday. And when I share it, we'll see what rates of return we wound up coming up with. Now, do they work well in longer markets, longer term markets as well? Yes. But for me, Brad, I haven't traded a credit spread longer than a week, maybe 7 or 8 days at max, but not longer than that in 7 or 8 years. My credit spreads are either day trades or they are weekly trades. I'm very short term in and out of that trade. I don't hold for a long time here. I don't want to. So Hertzgrama said they only make you buy it on expiration day if it's below the 95. So yes and no. Understand the rules of options. As a buyer, you have the right. As a seller, you have the obligation. What does that mean? It means if this stock gets below 95, you may get put to you at any time. But I have had on occasion, once or twice, where the stock was above 95 and they still made me buy it. And the reason why you have to understand is they did something to manage a position, more than likely that they did not have enough cash to cover the trade. So they said, okay, I don't really want to make them buy it at 95 while it's trading at 96. And I'm okay with that if they do. But there are occasions that can happen. So with that being said, you can be exercised at any time. But normally you will not be exercised until the last day or two of the week unless there's a massive move. What does that mean? Stock closed at 100 and it opens at 50. You're getting exercised even if it's a Monday. It doesn't matter. That's too much premium for that person to give up. They'd be crazy to let it go further than that. So more than likely they're going to close that position out, whether it's exercise or however they handle it, but you can be exercised. Which you see, that's where we run into the risk in a naked put trade. Now, full disclosure, I love naked puts. It's one of my favorite trades of all to do. But what I'm going to do is take this strategy that just had some of you do the pucker effect and go, and say, I can't afford to take that kind of risk. Awesome. Then we're going to put some protection or insurance on this position. So if we're wrong and it goes against us, not by a little bit, I'm not worried about a little, I'm worried about big. Right? You could say, well, Rob, I drive my car and I don't really have car insurance. And that's fine until you get an accident. Then you need the insurance. It's no different here. Naked puts are fine until you have an accident. And when you have an accident, you say, boy, I wish I would have had an insurance policy on that trade. And that's what a credit spread does. It limits our profit. In other words, we took in $1 here originally on this trade. We're going to give some of that dollar back just to be able to protect ourselves. And I'll share that one with you in a moment. So let's see. All right. Good, Brad. Awesome. So Chintan said, what is the better vertical option strategy for a bullish outlook? Debit call spread versus a credit put spread. In what scenario would you prefer one over the other? All right, so Chintan, here's the thing. I have a woman I work with. She's actually in here with us. She's in here, helping out, answering some questions if you guys have them about wealth builders. And she is a tremendous debit spread trader. You've got to define the difference. A credit spread, I get paid. A debit spread, I lay money out of my pocket. When I am in a trade, here, if we go this way, and let's see, I want to do that. It's paint, that's why. Yeah. So let's do another one here. All right. If I buy a call option, if I buy a call, that means I think the stock is going up. The only way that I make money on this trade is the stock has to go up. That's it. If the stock goes sideways, the value of the option will deteriorate. If the stock goes down, the value of the option will deteriorate. If the stock goes up, that's the only way I have a chance to make money. If I do the equivalent of that, which is a bull put spread, If the stock goes up, I make money. If the stock goes sideways, I make money. If the stock goes down a little, I make money. Right? The only time I get in trouble is if it goes down a lot. So I have a 2 out of 3 chance of making money, possibly a 3 out of 3 chance of making money. Professional traders are sellers. They're not buyers. Guys, I know we all want the home runs. We're all looking for I want to hit it out of the park. I'm looking to make $10,000, $50,000. I want another GameStop trade. My cousin was telling me this week he saw a kid in Queens, in New York here, driving a car around that said the license plate was GameStop, GME bought or something like that. And it was a BMW, right? And he said the kid looked 19 or 20 years old, that he probably bought a couple hundred shares of GameStop, made himself 30, 40, 50 grand and bought a car, right? GameStop bought or something like that. We all want those trades, but here's the thing. I remember as a young boy, I remember watching the New York Mets. Yeah, sorry, that's just the team I like, right? I'm not after the winners. I'm just after the one that my dad liked, right? Call me sentimental. And I remember Dave Kingman, right? Home run king. He was also the strikeout king, right? Swinging for the fence, miss, you're out, right? If he connected, man, it was great. The crowd cheered, and he batted 280 or whatever it was. And then you got other ball players that were base hitters that had 320, 340 batting averages, right? They got on a lot over and over and over and over again, causing something to happen, an opportunity for the game to move in your direction. It's no different with trades, right? I want to get on base as many times as possible. If I can learn to limit my risk in the strategy, okay, and have a better chance of being right, I will take a smaller premium for that. I'll get in my trading, I get 6, 8, maybe 10 really good trades a year. Everything else is base hit. I got on. If I'm trading for contracts, 10 contracts, whatever it is, maybe you made $200, $2,000, $12,000, all good trades, right? Anything over 15 grand for me is a home run, right? And we've had a couple of really good trades in one of the programs that we teach this year. What do we do on Amazon? One trade, I want to say 73 grand it was under a week. I don't remember the exact time frame. It was under a week, right? So I like credit spreads better. Now, debit spread, it's just a different type of trade. So for me, scenario doesn't really fit there. That debit works for me. I don't like it as a structure. Amelia crushes it. She kills it with debit spreads. That doesn't mean the spread doesn't work. It's just not the one I choose to trade. It's not the one I choose to use. Okay. Jason said, Robert, how do we trade live with you? Well, a couple of different things, guys. I'll share some stuff with you in a little bit, but keep something in mind. If you go to tradewithrob.com, 2, 3, 4, 5 times a week, I put a video out on a candidate that I'm looking at for tomorrow. So go ahead, put your email address in there so we know where to send you an email. If you want an SMS, you can put the SMS in there, but not required. And then we send you a trade. I do, a couple of them a week. It's usually 2 to 3 a week, but depending on the week, we could have 5 in there. I never do more than 1 a day, right? So check it out. Let's see. Vu said, credit spreads, you are the seller of the option. Debit spreads, you're the buyer of the option. Yes, we're correct. But keep something in mind, Vu. You're the seller of the one I showed already here, the $100 strike. You're the seller, right? What we're going to do at this point now, let's see, we just can't wipe all that out. Okay, now we're going to step in here and say, okay, what's next? Because we sold to open, but we also need to buy to open. ETO. Get used to this phraseology, guys. You're going to see this every week from me. Right? And we're going to buy to open another option. Let me just make sure that I'm okay with the questions here. Brad said, what criteria do you use when choosing the whoops, missed it. Let's see, it's on the next page already. Back it up. When choosing the current week expiration versus 110 or less. Oh, I'm only choosing current week, Brad. Unless we are Thursday and Friday of the week, I'm going to go for, or if it's a day trade, and I do day trades on these all the time, right? I love day trading, credit spreads, directional moves. I'm a big fan of it, especially in this market. On one of the strategies that we teach, day trades this year, had you done one contract, you'd be up $40,000 if you took every trade that we gave. And on our swing trades, you'd be down $2,000. All right. Why? It's not me. It's not I'm bad at picking swing trades. It's the market condition that we're in. You get 1 or 2 days in a direction and a whipsaw back. You get 1 or 2 days in a direction and a whipsaw back. So I'm going as short as possible with day trades wherever I can. All right. Let's see. Gregory said, I'm understanding that the idea of all of this, don't know how to implement the trade. And I'll show you. Well, we'll go into, listen, Gregory, we're talking years of experience and working on these for me. I'll share with you a lot of the insights on them today. All right. We'll actually, if we have the time, we'll actually go in and look at putting a practice trade in so you can at least understand the mechanics behind it. Brad said low implied volatility using debit, high implied using credit, generally using high vol rank even better. Yep. And you will have higher volatilities on what you sell. Let's see. Sell to close on Riot, 50 call, 49.68 cents right now. Okay. Dave Kingman, did he hit some massive home runs? Yeah, he sure did. He was the home run king, Kingman, right? So guys, if I pronounce your name improperly, I apologize up in advance. He's not telling us that brokers don't allow us to trade spreads. They're not. Okay. I don't know, Tyler, I don't know who your broker is, but unless you've done something on an application for a broker that is causing them, here, you check the box that said, oh God, I can't lose a penny. Yeah, they're not going to let you trade spreads. They're going to let you buy stock, right? I won't open a brokerage account if it does not give me access to at least naked puts. That is me personally. But I'm talking experience since 1997, I've been trading naked puts. So, but brokers do allow you to do it. Actually, you could do them in IRA accounts. They're that safe. They have a higher safety factor than buying a stock does. So, as far as margin component goes. Gregory said, I'm just so afraid to make a mistake implementing the trade and managing. Gregory, that's what practice trades are for. You want to put this in on a non-funded account to start. You never want to put this in with real money. We only tell people that they should be doing this on practice trades to start. Yeah, listen, TOS, right? TOS will let you do them. TradeStation will let you do them. Interactive brokers. There isn't I don't use IB. It's a little more complex for me than I like, but they've got stuff in there that professional brokerage firms don't know how to use. That's how in-depth they are. But there's not, if you have a larger account, there is not anybody out there that does better for margin on stocks, options, it doesn't matter, on your positions than an IB does, Interactive Brokers. Pick one of the majors. Stay away from the website guys. And listen, I'm not bad-mouthing anybody. Whether you use Schwab or Fidelity, if you like them, you use them, okay? For me, I like the ones that focus on traders, not on investors. Right? If they've got an investment arm to their business, then that may not be the one to be with. Tastyworks, phenomenal. I'm not a fan of the ability that I don't have the ability to exit a trade because I have an account with Tasty. Guys, listen, I have an account with Tastyworks. I have an account with TOS. I have an account with TradeStation, which is my primary broker that I work off of. That's what you'll see me use here is TradeStation because I know it the best. Tastyworks does not allow me to exit a trade on an option based on a stock price. It only allows me to exit based on an options price. And that is a problem for me. Full options trades. Oh, yeah, no, yeah, it involves. And listen, commissions, if you're trading large number of contracts, Tastyworks is the best one because they cap commissions. On a directional trade, it's either $5 or $7. I forget now. I think it's $5 on a directional trade and $7 on a spread. So if you did 100 contracts of the SPY, you're paying as if you only did 5. I think it's 5. Logan, why is what an issue for me? Sorry. Why is not being able to get out based on the option price versus the stock price? If that was the question, if you know anything about options, you could see that the stock price, it goes up and an options price stays exactly where it was. It never moved. because they do an implied volatility crush, crush implied volatility, widen bid-ask spreads, and now I'm getting out based on the stock price, on the options price, not on the stock price. So stock hits resistance. My option never moved. I thought I was going to get a $13 on my option, and it's still down here at 10. Well, the stock hit resistance, but the option never moved, so I'm not out of the trade. That's the reason for it. Yeah, Navos, I'm a big TradeStation fan, but if I was starting over, TOS would be the company I would pick. They've got much better, much more in-depth options components. I understand you may not like the option chain. I don't like the colors of their stuff. You know, I'm a TradeStation fan through and through. No, it is just water, guys. Just keep that in mind, okay? Just water. All right, cool. Okay, we're going to keep looking at this, guys. Yeah, I never thought things would be this slow and weak. My swings have not moved. I agree. General accounts in Canada can only buy calls or use covered calls on stocks you own. So then, Brad, the way that you do it, not for a teaching for today, is you set up an entity inside of the United States. You use that entity as the place to put your money and set your broker account up, and then you're trading in the U.S. I've got students that are in all different levels of our trainings, all the way down from brand spanking new, they don't know a stock from a rock, to students that are in our highest level coaching in our inner circle programs that are from Canada and have accounts set up here in the US. So you can do it, including one of the women that works with us, that works for me. She lives in Canada and she's set up and structured in the US for trading. Let's see. Yeah, sipping on some moonshine. Exactly. So we're going to go ahead and buy to open an option. Let's jump back in on this one, right? We would buy to open a lower strike. So let's say the $92.50 put is what we would buy. And again, just for simplicity purposes, we're going to make the numbers real simple, 50. So we're going to buy the option for 50 cents. Well, what does that mean? That means we're actually laying out of our pocket. Where's my bracket? Okay. We're laying out of our pocket 50 cents. So bottom line, my total premium is 50 cents. Right? Why? Because I sold for $1 and then I bought for 50 cents. So there's 50 cents left over. That's the premium in my pocket. Now, here's the coolest part about it. If we are right in this trade, cash in, and here's the formula. Actually, let me go ahead and grab I'm just gonna, I don't know, Spencer, help me out if you have here, but are there drawing tools inside of StreamYard? So here's the formula. Cash in, CI, that's cash in my pocket over cash out. Cash in is what? Cash in is the 50 cents. That's how much premium I took in, right? Cash out is the difference between the two strike prices. So we had the 95 and the 92.50. The difference there is 250, right? But I also took 50 cents of credit in. So we're going to take that 50 cents away also. So I needed $2 in order to do this trade, right? Cash in was 50 cents. Cash out was $2, right? What are we looking at for rate of return, right? If we look, cash in was 50 cents divided by 2. That's a 25% rate of return on this trade for the next day, 3 days, 5 days, 7 or 8 days at most, right? That, ladies and gentlemen, right there, I will take 25%. I got asked to come on to it was a Tuesday morning show, I think last week before last, for Benzinga. And I was asked a question by one of the hosts of, Rob, why would you take such a small dollar amount rate of return? It wasn't a 50-cent rate of return. It was on a different trade. It was on a covered call. And it's not about the dollar amount. That small dollar amount equated to a 6% rate of return for a week. Don't get hung up on the dollar amount. If the dollar amount is too small, do more contracts. This trade requires $200 of cash in order to do the trade. If you don't have $200, then this is not a good trade for you, but you're probably not buying stock either, right? And if you are, you're buying stocks that are probably lower priced and have very small moves. Now, I'm not saying that's a bad thing. You trade where you're at. There never, ever, ever should be a point of, I only have X and I'll wait till I get Y before I start. No, you start now. Don't wait. You start now. And you start where you're at. If you have to trade lower price stocks, you do it. But here's the secret. You could trade options on higher price stocks with the same amount of money you're trading the lower price stocks for, which means you'll get bigger moves, bigger rates of return from it as well. Let's see. Brad said, but I have to have a minimum of $25,000 US to use my margin account. Who's that with, Brad? Brad said, I pay $7 and $1.25 per contract because I live in Canada. Waiting for Tastyworks to hit Canada. Same guy that, but yeah, it's Saganoff. Yep. Yeah, I mean, listen, they do a great job. I'd love to see them get in Canada. We have a lot of students there as well, but I have students using TAS and TradeStation in the US because they're using their corporate entity as as what they're trading from, their corporate address. So Logan said, are these options at the same expiration date? No, I didn't mention it, Logan. Good question. And don't ever be afraid to ask the question. If you missed it, that's okay. I'll repeat it. Not a problem. They are. The only way they become married, and the only way that marriage works is if it's the same thing. If you're in Houston and the person you're marrying is in LA, you might be able to do it, but it's going to be a little bit of a problem. You need to be in the same place, right? The same church, the same synagogue, the same justice of the peace. You want to be together. To make this married, you have to be together. So we use the same expiration date for this trade. And that's what makes it vertical. It's called a vertical spread. This credit spread is vertical. All right? Okay, let's see. If you own 100 shares, you can print them. Okay. Maybe I got to stop reading some of these things until I read them to myself first. Let's see. Vertical credit spread, same expiration date, different strike. There you go, Amelia. There she is, guys. That's Amelia, WBHQ. Yep, WK, I'm going to share them with you. Let's see. We got a whole hour here today. So Gregory said, with the example we're working on right now, what would have happened with the price of the stock if you lose money? So the price of the stock has to go down below where? For you to get in trouble, the stock has to go down below 95. If it goes down below 95, somebody's going to make you buy the stock at 95, and then you're going to turn around and make somebody else buy it at 92.50. So you've got $2.50 of risk. That's the difference between the price. I don't want to do that. That's the difference of the strike price right there. Okay, let me do it with my pencil. It seems to work a little bit better. That's the difference of this price here and this price here. $2.50. But remember, they already paid you 50 cents. So your maximum risk in this trade is $2 on this transaction. So that's worst case scenario if the stock were to go against you. But keep something in mind. If the stock went down to 94.50, they're going to make you buy it at 95. You're going to make somebody else buy it at 92.50. Guess what? You still had that 50 cents of premium in there. So you reduced your cost basis in this trade. Give me a moment on that, Vu. I'll handle that. All right. So let's go ahead here. Okay. Let's look at here. Let me share with you first some examples from today. And these were actual trades we did today. I've got two of them to show you. There we go. That's one. And let me zoom in on a little bit. And I don't know which one I grabbed first. I just grabbed it. So those of you that are familiar with TAS will recognize the platform down below, the very bottom, which is where we entered in. So if I go ahead and grab a pencil here, the lower portion, look at the timestamp, 9:34, that was our entry. We did a credit spread on Etsy. Okay? We did a credit spread on Etsy. We sold, and you can see where we ended the trade. Okay? Right in here. Okay? We sold on Etsy the $215 put, and at the time it was worth $259, although that doesn't matter, and I'll show you why. And then we also bought the 212 and a half put, and at the time it was worth $1.46. I don't care about those numbers. What I care about is my debit, my credit. They paid me $1.13 to do this trade. So right now, my maximum risk is the difference between these two strike prices. Let's get a pencil again. This is my maximum risk in the trade minus my credit. So I have a $2.50 max risk minus my $1.13. That gives me $1.37 is my maximum risk in this trade. The most I could lose on the trade is $137, period. Okay? Well, that's the entry of the trade. The exit of the trade came much later in the day. How much later? 30 minutes. Look at the timestamps. Right there. Etsy, 215, 212 and a half put. We had a debit of 42 cents. So what does that mean? That means if you take $1.37 and you subtract 42, that gives you 95 cents. 95 cents. So I made $1 in essence by having $1.37 on hold. And I did it in a half an hour. So what are we talking about? 51.8% rate of return. How many of you like a 51% rate of return for 30 minutes of work? Nice play. 1 for yes, 2 for no. Remember the participation thing? Do you guys like a 51% rate of return for a whopping 30 minutes? Good. Good, good, good. I know there's a little bit of a delay at times. And you can see on the chart, we got in here, right? So what happened was these are pivot points, right? These lines are pivots, right? And this on Etsy, 1 minute chart is a Tosh chart. For those of you that know what I'm talking about, that know Tosh, you know what I'm talking about, right? And it's a little hard to see all the numbers in here, but because that arrow kind of blocks it out. But 31 minutes, right? We got in at $1.13. We got out at 42 cents. That would have left us with 95 cents of premium left over. I don't know about you, but to me, it's an absolute home run. And this is today. Look at the date, 4/9. Right? The other one we did today, we did not enter into the third trade. By the time we got to it, it already had moved the opposite way. So we couldn't do anything with it. That one right there, I believe. Okay, here we go. Let me make it a little bit bigger. There we go. Beautiful. So same scenario. We got into this one right behind the first one. So as we exited out of our first trade, we were entering in here. So you can see 10:04 is the entry time. We had the 360, 357 and a half puts. So once again, $2.50 is the max at risk in this trade. We sold it at 64 cents. Okay, not too bad. 10:37, so 33 minutes-ish. 33 minutes. We paid 10 cents to get out of the trade, which means we kept 54 cents. You needed $200 to do this trade to make 54 cents. If you put in and did 10 contracts, you need $2,000 to make $540 in 30 minutes. I would venture to say most people in the United States do not make $540 in 30 minutes. Now, I'm not saying you're going to make that every 30 minutes. If this was your only trade of the day and you were done? If you can make $500 a day, that's $2,500 a week. You're talking six figures for the year. For most of you, you're done, because most people in this country do not make that. Rob, I make a lot more than that. I understand. Then maybe you do 20 contracts and you get $1,000 a day. $1,000 a day puts you at $220,000 a year, since there are about 220 trading days in a year. Would I make more than that? Then do 30 contracts and make $3,000 a day. That's 600 grand. You see where I'm going, guys? It's math. That's all it is. It's geography, right? Location, location, location. Where are you in relation financially to where you want to be, right? You trade the number of contracts that fits what your account size is and your risk profile for that specific trade setup. So, guys, both of these trades were day trades utilizing credit spreads. Now, I'll show you some that could be potentially swing trades also, swing trades, longer term, where you could do them for next week. 10 contracts. Now we're talking. There you go, Big. I'm with you. Beautiful trade on Etsy, Brad said. There you go. Appreciate it, Brad. Gregory said, I thought when you sell a put, you want the stock to go down. Actually, Gregory, your hat's backwards when it comes to selling. So when you buy a put, you want the stock to go down. Because if the stock goes down, the value of the put increases. If you sell a put, well, it doesn't matter. Let's say it this way. If you buy a put, and what does the stock do? It either goes up or down. If the stock goes down, the value of the put will increase. If you sell it, and again, it doesn't matter. If it goes up, the value of the put will decrease. As a buyer, when I buy, I want the stock going down. As a seller, I want the stock going up for puts. Calls are opposite. And for a call, you're hoping the stock to go up, Gregory. Right. If you buy a call, you want the stock to go up. If you sell a call, you want the stock to go down. So Hurt Scrambler said, why does some options not have options trading on them? It really comes down to A, the company allowing it to have options traded on it, and B, finding a market maker that's willing to trade options on it. You know, you'll find stocks out there that the options pricing is amazing. So Apple is a great example. Come on. Where'd it go? Oh, I've got my drawing tool still going. That's why. All right. So if we go to Apple, Apple's options prices are amazing. The prices are fair. The spreads between the bid and the ask are fair. So an option I would trade if I were buying a call option on Apple right now, we're looking at 310 by 320. Right? That's a fair bid-ask spread. They're really not taking advantage of you, right? Let's see. Ford. Nope, I put an S in there first. Sorry. Well, actually, we'll go back to that. SF. All right, look at SF. 510 by 890. Holy mackerel. 510, but I can negotiate the spread, but man, I'm going to dance with the devil on this one when I'm trying to get out. They're going to play serious games with me. Telray was another one. On expiration date, I have had serious issues on expiration date with options and their bid-ask spreads. They're better now, but man, I have just danced. 73 by 82, not too bad. 72 by 82, not bad. 15 cents here, 15, not bad at all. Right now, of all of them, Booking is number one, right? Booking, 610 by 1070. 810 by $16. 1040 by $18.50. Whew, right? Dancing with the devil or with the market maker in this scenario, in this case, right? So the broker has to, not the broker, the company has to agree to the options, but so does a market maker has to agree to sell them. And many of them kind of get forced to take them. They don't want to, so they just open up the bid-ask spreads and say, don't bother me. If you really want this, pay me a lot of money and I'll let you have it. So no rhyme or reason as to, how it all comes out or not. All right. Love it. Got it now. Good, Gregory. Yeah. Thanks, Buck. Rubs in the house. You're welcome, Dontello. You're quite welcome. Listen, I love this stuff. BPS, bullish put spread. Correct. Bull put spread. I don't dance. Me either, Big. Look at me. I ain't a dancer. Not what I do in life. Okay. If I'm a week out from expiration, any chance of making slight recovery, not taking a big loss? You mean on this trade, RMA? Not sure. Ramarid? If you're talking about on a credit spread, it really, you have to look at every chart. You can't say as a definitive, yes, it's possible, or no, it's not. If it's out of the money, or moved this much or that much against me, you can't really say that. You've got to look at the chart and determine where it is on the chart. Selling a put interest in zero open interest, not a great plan. Actually, Bob Zeller, we don't care about it in that scenario. Open interest is not a component we look at for credit spreads. Debit spreads, yes, not credit spreads. Could you give us a SPY option pick for next week, the 408 put? You can pick the 408 put, sure. I'm not sure what you mean. Guys, I hope you understand there is a lot more to it than just pick an option. Here's the SPY. Where is the SPY sitting right now? If you look at it, where is it sitting? All right, let me take this down, make it a little bigger on the screen. And I'll get rid of that bar. All right, where is it sitting? It's near resistance. So for me, I'm either A, going to play a short-term pullback down to that 404 level, or I'm going to wait for it to get above 410 and look for it to run to 420. But I don't just say we want to trade this option. But if it did get above the 410, and let's say it was right now and it closed, and on Monday morning we were looking at this, then for SPY, and I'll share this, and I want to go in and look at the credit spread setup. Right? Keep in mind that options on SPY expire every other day, Monday, Wednesday, Friday. So here we have options for Monday, right? 3 days away. And I'm bullish. And we got above whatever that level was, right? I don't remember the number. My delta has to be at least 65. So here we've got a delta of 72. It's 238 by 240. I would be trading the 408 right now if we got above that level, it's a new day on Monday, and we're looking at a move up, I'd be trading the 408. It's got a 72 delta, very small bid-ask spread, which the SPY normally does. It's got a low implied volatility, super low implied volatility, right? Even compared to its historical of 14, it's at 8, right? And do I have fair value on here? Yes, implied volatility, no, theoretical right here. So it's selling at $2.43. Theoretically, it should be trading at $3.16. That's all indicative of the low VIX value right now, too. So it should be trading at $3.16. We get to buy it at $2.44. Home run. Logan said, do you ever roll up or roll down on your options contract? Is that a legitimate strategy in minimizing risk? I do it on covered calls all the time. So today I rolled out of Carnival into next week. I rolled out of American Airlines into next week. I rolled out of Ford into next week. I don't remember the others, but those three I already rolled out of today. I still have one other one that I've got to manage it today. It was a little bit further. It had a few pennies that was in the money of intrinsic value, cash value. So I want to wait till the end of the day. They were really raking you over the coals with the time value. So I'll wait until about 3:45, 3:50 to go ahead and manage my way out of that one today. So if we look at it, if we look at one of these positions, so let's take a look. Watch. Let's go through a scenario. All right. So let's take a look at W, right, which is Wayfair. Now we've pulled down below that 328.73 level. We've got some lower highs in there. We're sitting there at key level. If we get a bounce, possibly that one could work. If we look at, let me get rid of that, AMT. All right, so I like AMT. I like that strong move we had. Finally, we get a pull back to our moving average. If we can get a bounce on Monday, I'm looking at AMT as a potential trade. I want my short leg, the one I sell, to be somewhere down below that 340. So on AMT, I'm looking at a 237.5 put is what I'm looking for. So let's go take a look at AMT. Right? AMT. I don't need all the strikes. Let's just go to 20. That should be enough for us. And let's go look at next week. Right? So here's the thing. I'm looking at something down below that 237.5 level. Right? Which takes me right here. All right? 285 by 320. Fair value is 460. So we're still, the price is good. Spread's a little wide at 35 cents. I can negotiate it. But watch, here's the trick. On TradeStation, I know you can do this on TOS also, right? On TradeStation, I'm going to change it from a single to a vertical. I'm not changing anything on the filter. I'm going to leave the same strikes together. And what happened was my strike price is now combined together. All right? They now combined. So I'm looking at selling the 237.5, and I'm actually I was looking at calls, not puts. The puts are on the right side. I'm looking at selling the 237.5 and buying the 235. So this is my trade right here. Is this one here. So we're going to sell this trade right here. If I just click on the bid price, right? And let me switch it just to one contract just for math purposes, all right? So it shows that I am going to buy let's do the sell first. I'm going to sell the 237.5 put. Notice it doesn't have a price here because we're not selling the option for a price. We're selling the married position at a price. So I'm going to sell the 237.5 put, and I'm going to buy the 235 put. And I'm doing that at a cost. Naturally, I could take 60 cents of credit in. If I want to negotiate, I could go to the 85 cents, which is the mid price. And TradeStation has a column, so does TOS. I don't remember TOS's name for it, but I think it's mid also. A mid price right here, 237.5, 235 of 85 cents, right? So we can click on place order, and this is in a simulated account, right? So what is this showing? Yeah, I'm not ready to trade this until I see it move up on Monday. Buy to open one AMAT, 16th of April 21, 235 put, and sell to open one AMAT, 16th of April 21, 2021, 237.5 put, and that is an estimated max profit of $85. That's what I'm looking to take in, my credit of 85 cents, and my estimated maximum loss is 165. So it's telling you right up front exactly what it is. Right now, if I hit yes on this, it's not going to fill because I'm trying to negotiate. Right? So I have to wait for that price to get there. It shows me that it was received right up in here for that trade. If I went with the natural on the price, then yes, I think the natural was what, 60 cents? I think the natural was 60. All right, so let's cancel this order and let's go back to the option chain and we'll get the same order again, 237.5, 235. We'll click sell, change it to one contract. We'll go with the natural price on there, place the order.
Order filled.
Order filled, right? That order is now in place. You see +1, -1. Right? If I open back up from vertical to single, you will see where I have the two positions right there. 237.5, I am short. 235, I am long. So if AMT drops to $200, my risk is at 235. If it goes down to zero, my risk is at 235. I have that $2.50 max risk in that trade. It never can be more than that, period. That is the most I can be at risk at. Brad said, I learned my lesson when trying to roll vertical spreads 3 weeks ago. When I initially sold them, neglected to check further weeks out for open interest, was able to find enough. Okay. Yes, Jerome, my Roth is set up with TradeStation. Tasha's Mark. Thank you, Kat. I appreciate that. And not mid, it's Mark. Not the person, Mark. That's what they call the midpoint, is the mark. Gregory said, holy cow, I think I get it. I was waiting for a Batman analogy in there, Gregory. Holy cow, Batman, or something like that. How long might you hold this trade? So if you trade what we call the Amelia trade, if you trade it the way Amelia does and she gets in and out the same day, normally she's waiting for that next move to that pivot point where she can get out for 5 or 10 cents. And here, guys, you want to know what her secret is? She is capitalizing on the early high prices of the options early in the day where they start to lose value through the day. And then by the time you get to 10:30, 11, 12 o'clock, they've stripped some of that premium out from the initial offer. And she's seeing a natural decay in price just by getting in at the right time of the day. Right? I'm telling you, folks, as you come over and work with us with Wealth Builders HQ, guys, check out, literally, go and check out this Trade with Rob. Right? I don't know. Can I even put that in? I don't think I can. Amelia, if you dropped it in there for me. Yeah, holy cow, it's a donut, Batman. I get it. Good, Tony. Good. So, Rob, net seller, you want high delta. Net buyer, you want low delta. It's actually the other way around, Vu. In general, as a buyer, I'm going to buy 65 to 85 delta. As a seller, I'm going to sell a lower delta, depending on the trade. Every strategy has a different delta. Every length of time that you consider has a different delta. If I'm buying a leap option, I am buying a lower delta, more like a 40 delta. When I have leaps on Apple right now, right? I'm out at about a 40 delta, 42 delta or so when I bought those options, okay? Because they're very long-term options that I'm dealing with. But if I'm buying Apple today, for today, 65 to 85 is my delta. When I'm selling, one of my strategies, my iron condors, I sell a delta of 7 or 8 on the rut, right? But guys, if you check out this website here, Trade with Rob, we send out 2, 3, 4, 5 trades a week, not a day, a week on, here's one trade, this is what I like for tomorrow. Here's the entry, here's the target, here's the stop, right? It's all part of the video. The videos are 3 or 4 minutes long each usually. I could get long-winded and make it 5, but that's kind of where we are. I know, Tony said, I never want unlimited potential risk when selling. Right, Tony. So if you have a vertical spread here, you've greatly reduced that risk. I cannot be risked, do not have a risk any greater than in this case of the sample I drew out than the 92.50 put. That's it. Anything below there, I'm protected. So my risk only happens between 95 and 92.5. Let me rephrase that. My risk is lower than that, but I cannot get any greater risk lower than that. If I close at 94.99, I've got a penny in there of cost. If I close at 92.50, I've got $2.50 of cost. If I close at 0, I have $2.50 of cost. We stop our risk at 92.5. Just the cost of the spread, correct. Just the 2 strikes, the difference of the strikes, Tony, that's where our risk is. Yeah, so Gladwin, I'm not doing Tesla for next month, so I would not be the person to tell you that because I think that's a mistake. Tesla is such a volatile company to try to go a month out from now and say, where's the price going to be where I can limit my profit potential on that trade? The answer is no. You don't do this on stocks that have great movement potential to them. Tesla is a whipsaw. I would day trade Tesla with this possibly, but I would not hold something out for a month on Tesla on this, right? I showed you how to pick the strikes. We looked at some form of support. So on AMT, I said I want my strike to be below my support, which is my moving average. That's where my strike is. Because guys, if our candlestick tomorrow, not tomorrow, we're not open. If our candlestick on Monday does that and it's bearish, let's say it closes at the bottom of the candle, are you really interested in buying a stock there? I don't think so. I want it back up again above my moving average before I go and take an entry. So my stop is going to be when we break somewhere down below support. So I want my strikes somewhere down below support. When Amelia does her trade, she's looking for 50 cents. That's it. Can I get 50 cents? Min said, I just signed up. Excellent. Welcome aboard. You as well, Logan. And if anybody else that did, I didn't see it all.
That's quite all right. That was
Rob, you're so transparent, very easy to follow. Thank you so much. Absolutely. You know, I love doing this. You can't do it if you don't. I mean, you see with everybody here at Benzinga. If you don't love this, you can't do this. It's not for you. Spencer, what'd you think, man?
I loved it, man. I loved it. Super, and I will be transparent while we're being transparent with each other. For the amount of live streams and shows I've been on and articles I've written, I have a theoretical understanding of options, but a very poor practical understanding of options. I can explain options to somebody, but when it comes to doing it myself, I do not. So it's good to you explain it very simply, and it's good for someone like me who like I know what like the textbooks say, and I can regurgitate that, right? But I can't go beyond that. So this is good for me as well. This is informative for me as well, because I'm not like an options guy naturally. It's like hard for my brain for some reason.
Excellent. And then the good thing is, we've taken what I was first taught when I took my first training in 97.
Yep.
What I was first taught in there, I've taken that and morphed that into my strategy, into my system. So all these little tidbits, these are all tips that you guys are picking up that have taken me decades to hone in.
Yeah. Well, I am sorry that you root for the Mets, but we can't all root for winning teams.
Hey, I'm a Jets fan too. What do you want me to say?
I guess things can only go up. All right. Robert Roy, Wealth Builders HQ, Trade with Rob. Always a pleasure, sir. Have a great weekend. We missed you last week for the holiday. We'll talk to you next week, same time.
Fantastic. Take care, everyone. See you then. Thanks, Spencer.
Thanks a lot.